So today we're going to be talking about the things that we look for in a client's tax return. So I'll be asking Mike what he looks for when he collects his client's tax return, and we think you should do these things too.
Yeah, we're just finishing up on tax season, so this is super timely, and you can learn a lot by checking out your tax return. So hope you'll enjoy the episode.
Welcome to Operation Retirement Readiness, where Amy and Mike, two certified financial planners, talk about how military members can prepare for transition and how veterans can prepare for ultimate retirement. This podcast represents the views of the hosts and any guest. It is for informational purposes only and should not be considered tax, financial, or legal advice. All information is regarded to be from reliable sources. The hosts are not responsible for any losses, damages, or liabilities that may arise from the use of this podcast. This podcast is not intended to replace professional advice.
So Mike, I know that, like me, you collect all of your clients' tax returns. And so what I'd really like to hear from you today is about what you're looking at when you look at a client's tax return. I think it's incredibly important. It's a good way to make sure that we don't miss anything. We don't miss asking about things, because pretty much everything that's happening in a client's financial life will eventually hit a tax return somewhere. So as the tax season wraps up, everybody should have an opportunity to take a look at the return they filed, or maybe they're filing an extension. But can you just, talk to us about the highlights that you start with when a client turns in their tax return?
Yeah, it's a great question. One of the nice things is I think we both are using a tool that allows us to, take a tax return, run it through the tool. It flags a lot of stuff, pulls out a lot of data that makes it easier for us. But even if you don't have that tool, you can still, look at some of these important numbers to figure out what's going on in your tax situation, and did you, get it right, and maybe make adjustments for the next year. So, one of the first things I kind of look at is really a few things. What's their adjusted gross income? Because that's a key for a lot of different deductions and things like that. And then a lot of, our tax software, and even, a lot of preparers, if you're using TurboTax, doing it yourself, or, getting it prepared, a lot of times they'll show you what tax bracket you're in, and also what your, not just the tax bracket rate, but what your effective tax rate is across all your income. And so those are kind of, the three things I key in on first, just to get a scope of where the client is.
Exactly. Now, one caveat I'll make here is that the tool we're running it through is not AI.
Yeah.
So if you're thinking that we're just, putting a tax return into an LLM, we are not, and you should not either. So just to caveat that. So, adjusted gross income, like you mentioned, that's, absolutely critical. Things turn on and off when it comes to your adjusted gross income. But, maybe backing up a little bit, can you just kind of walk people through how you get to this number that people bandy about so often, adjusted gross income? What is it? How do you get to it? And where do you see mistakes for military families?
Yeah. So the adjusted gross income is, you'll get all your documents. Say that's the W-2 from the military, from DFAS. Maybe your spouse works, and they could maybe be a contractor. Maybe they get a 1099, and you've got your interest and dividends and all those forms that show the government that, hey, somebody paid you some amount of money. Basically that gets totaled up, and that is the basis of your adjusted gross income. It's called adjusted because there are some nuances on how things are treated, whether it's like Social Security may not be fully taxed. Well, it's never fully taxed. The max you're going to get taxed on the Social Security you receive is like 85% of that would go into the adjusted gross income. But lots of different things there, but that's basically what that is. It's the summation based on the rules of all the income that you've been paid for that calendar year.
Yeah. Yeah. And I mean, to your point, there's all these adjustments, right? So things go in there and get subtracted off sometimes. There's a big long list. That's not the purpose of this podcast. If you want to learn all about those things, there's some really cool exams that you can take. You can study for and take. um, Now, sometimes people get confused. They enter wrong numbers from their W-2 if they're hand entering things. Um, you know, when you look at adjusted gross income and, should you get a W-2, oftentimes we're not getting the W-2, but a lot of times you can pick up on the fact that, maybe somebody put, they put their entire, so their gross income, all of it, and they were making pre-tax TSP contributions. So there should have been a different number in another box that they used. So we can pick up on those kinds of things. What about, other sort of income surprises that crop up for military families sometimes, especially when spouses are working?
I mean, one of the big ones is, and kind of what a lot of what we focus on the podcast is that retirement transition. That can be a large difference between one year and the next. You retire middle of the year, you've had your military income, and then your pension starts, and maybe you start working very soon after retiring. And, so now you've got a bunch of different income streams. I find that is something that a lot of folks don't appreciate until they're filing that tax return. Like, holy cow, I owe a bunch this year because maybe they didn't have the withholdings squared away exactly right. Now, good thing is, you know, there's a thing called the safe harbor amount, which was, what you paid last year, either 100% of that or 110% of that. So you may not get penalized, but it could be a shock to have a big bill at that point. Um, and then how about you? What else do you see along those lines?
Yeah, I mean, sometimes spouses will do, side hustles that are 1099 contractor type side hustles. And so sometimes, there's not expenses taken away. Now you've got to dig deeper into the tax return to figure out whether expenses were taken or not. But, luckily the tax forms are, for all of the craziness of our tax code, the forms are supposed to be relatively intuitive. And for the most part, that's true. So, there's income that comes in from other schedules. So if you look in there, you kind of have to, it's almost like, peeling an onion. You have to go back layer by layer. So sometimes I do see that. And then the other thing that comes up in terms of income for military families are those rentals. So that's another schedule. It ends up on the front of the 1040, but you got to go back to the other layer of the onion and just make sure that you've deducted all of your expenses to include correctly deducting depreciation, which I see get missed lots and lots and lots of times, or it's done incorrectly, which you will hate when you go to sell that rental property.
Yeah, the IRS is unforgiving with that. If you don't take it or you mess that up and where you're not getting full credit for the deduction, it doesn't matter. You really can't. You could file amendments for a couple years, but if you've owned it for 10 plus years, there's no getting that back, and they assume you took it like you were supposed to. So you could be costing yourselves some money. So yeah, that's a great one that reviewing that is important. So what do so we look at all that. What's one thing, maybe how do you factor that in when you're trying to maybe make decisions about your current tax year, adjustments or things? What should you be thinking about along those lines?
Yeah, I mean, there are some ways that you can actually impact your tax return in this part after the tax year ends. Mostly that's not true, but in this part of the return, there are some options. So, for some people, if they're not covered by an employer plan, which usually doesn't include a military person, you've got TSP. But for some people, you can deduct traditional IRA contributions, and that can be done for contributions after January 1st, so between January 1st, April 15th. The other thing that you can take a look at is if you were self-employed. We mentioned those spouses that have the side hustle, sometimes the 1099. Depending on the amount of income, you could look at a SEP IRA contribution. Now, that might not amount to very much if the income's not a lot, but it could amount to quite a bit. And that deadline is actually not until the extension deadline, which is October 15th. So there's lots of time to deal with that. Beyond those things, I can't really think of any way that you can get it making a difference. What's done is done usually by December 31st, except for those couple things.
But, you said December 31st, but you're still in, we're in the 2026 tax year now. So yeah, you're not going to, you filed, we'll say, so it's now, okay, what do I do to either try to avoid if I'm not liking my situation, or just really understanding, do I have life changes coming up? I'm going to retire this year, maybe in the summer, and I've got a couple more months. Really thinking through that is, are you going to PCS? Is the spouse's income going to drop, and it's going to change the tax complexion for the next year? So that's really the point of this. Once you've put the last one, you've sent it to the IRS, you've hit that submit button, they've accepted it. It's really like, okay, let's start looking forward and figuring out the things we need to do something different. And it can come down to even, what type of retirement contribution you're making. You talked about TSP. Do you put it on the traditional side where you're getting the immediate tax deduction, or pushing it to the Roth side? So looking at all these numbers can really help you, make good long-term decisions. Anything around that you'd want to flag somebody to make sure they check?
Yeah, I mean, obviously, if you're unhappy with the income situation and you have power to, accelerate or delay income timing of, and some people, I don't necessarily. I try not to have my clients do this, but sometimes you leave the military and you end up selling leave back. So the timing of that matters and things like that. Now, Mike, so we've talked about, quite a bit of the kind of the top of the tax return, if you will, the first part of it. Moving into deductions and credits. So income to me is fairly straightforward. You get a W-2, you get a 1099, you hand jam it into the system, right? You just put the numbers from the boxes in the right boxes in your software, right? Now, deductions and credits, it tries to walk you through. But sometimes it helps really to understand what is exactly going on. And I think the first place to start is, the standard deduction versus itemizing. I think people get really confused by this. So walk us through, what you look at. It's easy to pick up on when somebody took a standard deduction for the most part versus itemizing. As people think about their own return, what advice do you have for them when it comes to taking standard deduction or itemizing or analyzing that part of the return?
Yeah, and I'll say this has changed in the last, was it 5 years or so? Whenever we got the Tax Cut and Jobs Act, that kind of radically reshaped this, where a lot fewer people are itemizing today. So most of my clients actually take the standard deduction, and it's the smart thing. It's now, for a married couple, it's over, I think, over $30,000 for 2026. So, unless really, the folks I see being able to take, advantage of itemizing are if they are very charitably inclined, or they've, mortgage and those type of deductions. But again, a lot of times, unless you've got a very, very expensive house and a large, large mortgage, it's not, making sense anymore, or, you've got medical issues that are unreimbursed type thing. But like I said, for the most part, I'm seeing 80% standard deduction and probably 20% of folks itemizing. Is that your experience also?
Yeah, I mean, there's this weird nuance. I'm in Maryland, so there's this weird nuance with Maryland, and I'm sure there's other states like this too. I just don't know what they are off the top of my head. And the nuance is that if you itemize at the federal level, um, if you take the standard deduction at the federal level, you have to take it at the state level. Now, if you itemize at the federal level, you could still take the standard deduction at the state level. And so here in Maryland, the state standard deduction was really small. So there can be some cases where, it would make sense at the federal level to take the standard deduction, but your itemized deductions are so close to the standard deduction that it actually makes sense to take, the smaller itemized deduction on federal, because overall, so there's that weird stuff that happens. The other things that sometimes come up is, in addition to the standard deduction, is that PCS moving expense deduction. And sometimes people miss that. Do you see people taking advantage of that?
Yeah, it depends on how. I mean, a lot of times there may not be that much that's not reimbursed. So if that's the case, then it may push them over the top to itemize. But again, if they weren't close, then it's probably not that big of a deal. So yeah, I see that occasionally with folks, but yeah. And then so beyond the deduction and whether they're doing the one thing, I guess the one thing I'd plug is really on the charitable side, sometimes even if you are very charitably inclined and can get, close to the standard deduction, it still may not make sense. But if you can stack a couple years together where you're making a giant deduction or gift in one year, and then you take the itemized deduction for that year, and then the other two you revert back, or 1 or 2 years you revert back, and just kind of maybe using a donor advised fund to spread that all out and be able to continue your giving. But overall, that's one potential strategy if you're in that particular situation where you are making large gifts. Anything else you'd add to that?
Well, I would add that, with the Big Beautiful Bill Act last year, it makes even more sense probably to stack your charitable deductions, because they went ahead and added a floor to be able to take the charitable deductions. Now, there's also, they went ahead and added the weird thing where, if you're going to take the standard deduction, you can also take a certain amount of cash charitable donations. So I think it's up to $2,000 that you can also take as almost like a standard deduction, kind of, sorta. So, so much for making the tax code simpler. We've just made it more complicated. But other than that, I can't really think of anything additional. We could go down so many rabbit holes with deductions, but I think that hits the high points for most military families.
Yeah, that was a good point on the change and yeah, so it can influence the charitable giving strategy. So again, if you're doing that, make sure you're talking to somebody who really understands the new rules and how it can help you. So
Yeah. All right, now, so deductions are great. Think of deductions like percent off coupons. But credits are like dollar for dollar reduction, which are fantastic. So credits are even more valuable than deductions. And, sometimes people miss out on credits. So Mike, what do you think are the most overlooked, or the tax credits that military families should pay most attention to?
I mean, the one that got the big boost this year is the child tax credit. And, so that impact wise, if you've got several kids, that's going to be a big, uh, you know, piece of the return this year that's going to knock how much you're going to pay down quite a bit. So that's, not that most people miss that. I mean, that's pretty standard that they'll get it, but you might be surprised at, how big it is this year. Um, the one thing looking at is the education credits and how that, got to really dig into that and make sure you're not kind of double counting if you're using the GI Bill, because there's only certain things that you can use the education credits for. So really, really understanding that. And then the other thing I see just with that one is as we get inflation and people's incomes go up and their adjusted gross income keeps going up, fewer and fewer people are qualifying for the education credits just because that's static in the tax code, doesn't get indexed every year. So that can be something that, over the next, say, 10 years is probably going to be fewer and fewer people that are even eligible to claim that. But it is there, and it's something that if you've got kids in undergrad, well, really any kind of post-secondary education, you ought to be looking at that and seeing how, if you qualify. Any others that stand out for you that people miss or at least should be aware of?
Yeah, I think sometimes, so with the dependent care FSA that came along, if you contribute to and you use the dependent care FSA, which, the max that you can contribute is 5,000 for the year. But a lot of times, depending on where you live in the country, especially if you have more than one child, you're going to spend more than $5,000. So you can't double dip. You can't use that first $5,000 for the dependent care credit, but you can use anything over the $5,000. So I think sometimes people get confused by this idea that you can't double dip. It's true. You can't double dip for the same dollars, but just because you use the dependent care FSA doesn't mean that everything's off the table. So that's something to pay attention to. And then I'll also make a note too. We were talking about, sort of income planning and things like that with respect to education credits. There can be times, especially if you're in a transition year where you retire, maybe there's a few months gap. Mike's right that, it is hard to qualify for those tax credits, but you might be close and you might be able to do some tax planning to get underneath the American Opportunity Tax Credit limit for at least just 1 year, which is a very valuable credit. That's a really nice credit. So, it might even be worth foregoing, depending on what your GI Bill situation is, but it might even be worth foregoing GI Bill in that particular semester or year, just to pick up that education credit. It's pretty valuable.
Yeah, that's a great point. That's a great point. So let's talk. I was
Go
going to
ahead,
say
Mike.
let's talk about the maybe look at some of the state tax stuff and thoughts about that.
Yeah, I mean, what a headache it can be when you're dealing with the Military Spouse Residency Relief Act. I don't know that many non-military oriented tax preparers who get this right. And it's confusing. I feel like they did make it less confusing. I feel like, in general, the spouse gets to pick their state of residency based on their existing state of residency or their service member's state of residency. Now there's nuance to that, but, stated plainly and in the most straightforward way possible, do you want your service member's state of residence or not? If yes, then it probably will work out. There's some, state level nuances that go with that. But I really see a lot of times, in fact, our good friend Paul, who's been on the podcast a couple times, has fixed several tax returns for my clients because preparers just assume that, the spouse lives in Maryland, they work in a Maryland job, so they have to pay Maryland tax, and that's just not true. What about you, Mike? Do you see that often enough?
Yeah, there's definitely, that's definitely something that we check regularly. And like you said, it isn't well understood outside of military preparers, or somebody that's had a lot of military tax clients type thing. So maybe they, know it better, but it's something that is missed, and or mistakes made. You're paying extra taxes that you probably didn't need to, type thing. So yeah, that's a great one.
And it's thousands of dollars a lot of
Yeah.
times. It's
Yeah.
it's a lot of money. And so, again, I I tried to make it as straightforward as possible. I mean, I guess what I would say is that if the spouse wants it to be their service member's state of residence, then I would say that you need to go find the reason why it can't be. You should otherwise just assume that it can be until you find the reason why it can't be. And honestly, like, I can't think of anything off the top of my head. Maybe I don't know about you, Mike, but I don't know if you can think of something. Sometimes there's state level rules on when you can become that state's resident, but like I said, start with the assumption that you can be the same state of residence as your service member. Go check the state rules and see if it precludes that. But don't be afraid to push back on your preparer, because so often, I've had clients who are like, we tried to tell the preparer, but they, so push back, take references, reach out to the Military Tax Experts Alliance, so MTEA, and ask one of those guys for references on it, or change to one of them as your preparer, because they understand how this works.
Yeah, exactly. I mean, I think that's probably the best advice is, find somebody who knows this stuff and does it regularly if your preparer does not. So,
Yeah.
um,
Now, Mike, so once veterans settle down, their state of residence becomes where they're settled at. They don't, get to pick the most favorable and keep
yeah,
it forever. They have to abide by their state rules. Um, you, what do you see in this area? So once somebody has picked a state, what do you see people missing out on, in terms of retirement pay and things like that?
every state is different. So it's again really understanding what the state offers. I will say, don't let the tax tail wag the dog if there's a reason to be in a certain place because family's there, or that's where a job is. I mean, you can take it into consideration, but just uprooting yourself, potentially to save some money, it may not be worth it, unless there are other reasons for you to relocate. So, uh, again, it's a consideration, but shouldn't be probably the lead consideration type thing. Um, but yeah, it's just that yes, once are officially retired, you're now a resident of the new location. So figuring out what that how that impacts. A lot more states have started excluding military retirement pay from being taxed at the state level, which is great. And, more, it seems like every year there's a couple more that, get on that bandwagon, at least partial exemptions. So, yeah, it's definitely something that, could save you a lot of money, depending on where you are.
Yeah. And one other thing that's not specific really to veterans, but it's something that I see get missed a lot of times, even if you have a preparer. So there is certain income that's not taxed at the state level. For example, um, for a while people were very into I bonds. Some people like to use treasury bills. So federal government interest, so interest that you earn from treasuries, is not taxed at state level. So you know at least for some states. So make sure that you exclude or figure out whether or not your software or your preparer has excluded interest if it's appropriate. It's probably not a huge deal for a lot of people, but it's a few bucks, so it's worth looking into.
Yeah, that's a good point. That very good point. So, all right, we hit the kind of big sections. The first the income, then the deductions and credits. Um, so let's talk just a little bit about using it really as a planning tool, and what do you say are the big things that somebody should do as they're considering changes to make in 2026 or even beyond, and how should they be thinking about that?
Yeah, I mean, I think the big thing, and I think most people know this, if you owe a lot or you get a lot back, that's an opportunity to make an adjustment. If you owe a lot, you probably also paid a penalty. And saving the penalty is worth it. I mean, I definitely have clients that don't care about the penalty. It would drive me up a wall, but some people just don't care. But you also don't want a big, huge refund either. And I know some clients really like getting a big refund. They consider it as like a saving mechanism for themselves. But preference is a small refund or balance owed, one of those two. And so in terms of planning, once your tax return is done, that is a really good time. And in fact, I do it for all my ongoing clients around, just after tax time. So right now, collect all the pay statements and run a withholdings analysis and figure out whether or not we're on track. And if you need to, if you can withhold less or withhold more, there's an IRS withholdings calculator, so you don't have to do this math on your own. You can go to the IRS website and you can figure out what your withholding should look like, and then you can make an adjustment in my pay.
Yeah, that's a good point. It with a bunch of streams of income, it gets a little more challenging to make sure they're all lined up correctly. But yeah, you can run that calculation and just make sure you're not taking those penalties as you talked about. So um, yeah, and
No.
then the one thing that I'd highlight is looking at really again around the savings or distribution from retirement accounts and how that all plays out, looking trying to figure out what that long-term tax situation looks like. If you plan to retire early, how should that impact where you're saving? And we've talked about that in some other podcasts. So just go back and look at, some of those if you're curious. But that can be a big thing where, again, you may be paying more taxes today than, you absolutely need to because you're trying to, you're recognizing income. Maybe you're doing some Roth conversions, but over the long term, many years, it's going to save you probably a lot of money. So really, really thinking through that is a key thing. Um, and then anything, we've talked a little bit about it, but anything for somebody who is transitioning into either, ultimate retirement or, military retirement when they're doing this.
Oh, I mean, I guess because we already know that there's going to be a change. So as soon as you say transition, there's going to be an income change. That income change might be higher or lower. We don't know. So probably the most important thing to get a handle on the current year return is since you don't, in a lot of cases, you have absolutely no idea what your income is going to be in a transition year. So how do you figure out whether you're withholding enough or not? That's when you can just fall back to what your safe harbor withholding should be, and it's probably listed on your return somewhere. So you have no idea what's going to happen. Just make sure you withhold the safe harbor. I think that's probably the key takeaway for a transition year.
Yeah, that's a good point. Especially if the income's going to go up, dropping, yeah, maybe, you figure that out. If you're totally stopping work, you may have a good idea of what you've made so far and how much distributions you're going to take, and you may be able to get it closer. But yeah, like you said, if it's going up, it can be difficult. And then make sure you're putting that money aside, even if you don't adjust anything. You get to that safe harbor, you're fine. You're not going to take penalties, but make sure you've got some extra money sitting aside for the next April when you're going to have to send it to the IRS. So yeah, that's good. So what else should we hit?
One thing we didn't hit is probably the number one thing that I pick up on and is not meaningful in the current tax year, but gets really meaningful later on. And I know you get it too, is when people are doing the backdoor Roth. So everybody talks about the backdoor Roth, lots of people do it, but then it never ends up getting documented correctly on the tax return. So it's that Form 8606. And, we're talking, after you do these for a while, you're talking, thousands, if not tens of thousands of dollars in double taxation if you haven't done the 8606 correctly. So, we haven't hit that, but that's probably one of the first things I figure out, when I look at somebody's plan and they have traditional IRA, getting to the bottom of where that money came from and then figuring out whether it got documented on a tax return at any point in time. That's huge. Let's see. Now, if you had to tell people, just 3 or 4 or 5 things that they, do on their tax return, can you just give us those top 3, 4, or 5 things that they need to hit?
Sure. One that we haven't probably hit really is, a lot of times you'll also get, if you use the same software or same preparer and your income's similar, a lot of times they'll give you the, difference between a couple years. And I find that useful to go through and catch mistakes that we haven't really highlighted. So if you have that, just scan it, make sure nothing looks way out of whack. And if it does, do a little more investigation. Now, transition year when stuff's changing, significantly, that may be a little harder. But again, if you're kind of in steady state, same jobs, reasonable, similar investments and things like that, it can highlight things where, oh, did I miskey something, or especially, hey, I used to get investment income and all of a sudden I don't. Did I miss a form? I've seen that with clients. So that's one thing. So first thing is pull out the return and actually look through it. Look through those numbers, especially if there are any summary things that the preparer or the software provides you, and then also see if there's any differences between the 2 years that don't make any sense and that you need to investigate more. What else did I miss?
Take a look at spouse state of residency and whether or not there is a state return, if there should be a state return, if there shouldn't have been a state return. And let's see. Yeah, I think those are the big keys. I mean, there's a lot of things to take advantage of, but I think that the most important thing is get the return out. Don't just consider it as a chore you had to get through. Yes, it is a chore you have to get through, but then once you've gotten through it, you already put in all the work. You did the hard work. Now go through and figure out how you can use the information to your advantage going forward.
100%.
So Mike, I gotta know, what is the craziest tax mistake you've ever caught?
I mean, the biggest ones, I've seen a couple times are, not taking the, or not taking it correctly, the rental property depreciation.
Mm-hmm.
And those can be large, and you're like, oh, there's no going back here. So you should have gotten money back, and now the IRS doesn't really care. There's no way to fix this for that. Is probably biggest monetary wise that I've seen. How about
Yeah.
you?
Yeah. Business stuff when DIYers, and I appreciate DIYers. I've always done my own taxes. I like doing them. But when it comes to business stuff, and if you're a DIYer who dabbles and doesn't commit, you can really mess up your own small business taxes, even if it's just a sole prop Schedule C kind of business. I have seen some doozies. I'll just put it that way. on a really messed up Schedule C, and not good, not good. So you just gotta try and get it fixed, and hopefully everything goes okay.
Yeah, yeah. All
um
right.
so I personally think this is one of the most valuable things that we do for clients, is taking a look at the tax return, even if we don't find a mistake. I just find tax returns so incredibly insightful. It helps me ask better questions, ask questions I might not have thought to ask because I didn't know. And the client forgets about it too, right? You forget about things that are going on sometimes. And so what I would say is, if you really like doing things yourself, this would also be the most valuable thing that you can do for yourself, is just take a look at the tax return.
Yeah, I agree. Investing and getting returns and really diving into that, people say, they call that alpha if you're generating more money than, maybe the index fund would have. But there's also tax alpha. And I think we both appreciate that. And most, planners that are really doing full on planning really appreciate that there are tens, if not hundreds of thousands of dollars, and maybe even more across a lifetime, where if you're doing smart things and paying taxes when you're in low brackets, deferring stuff when you're in high brackets, because you're going to be eventually in a lower bracket, that that has so much more benefit than picking that hot stock for most people. So really, this is key to financial health and happiness and wellness in the future. So yeah. So anything else?
I think we got it covered. Just go get your tax return, take a look at it, sit down with a nice cup of coffee or whatever you like to drink, and go through it.
Yeah, maybe something stronger.
Maybe.
when you look at that big number that you're paying each year to the treasury. Well, I appreciate it, Amy. I think this is good, and I think we give folks a lot to think about. So until next time, happy reviewing your tax return.
Take care, Mike. We'll see you.
Bye bye.
To get transcripts, show notes, or more information, go to operationretirementreadiness.com. Have a question or topic for the podcast? Send it to info@operationretirementreadiness.com. Find out more about Amy and Mike at their websites. Mike is the founder of Next Mission Financial Planning, LLC. He retired from the U.S. Air Force and has worked in the financial services sector since 2021. He is a certified financial planner, chartered financial consultant, and a certified college financial consultant. You can find out more about Mike at nextmissionfinancialplanning.com. Amy is the founder of Instar Financial Planning, LLC. She is retired from the U.S. Army and has worked in the financial services sector since 2019. She's a certified financial planner, a chartered federal employee benefits counselor, and a chartered retirement planning counselor. You can find out more about Amy at instarfp.com.